Welcome to my channel. In this video, we are going to talk about the fundamental of financial management, which is the very important subject in bachelor degree, especially in BBS and BBA. The very first chapter in the financial management is the financial ratios. I think you might have heard the financial ratios before. This is exactly same like in class 11 and in first semester. So it's really I'll start from the very basic. For example, quick ratio, the current ratio. So if I refresh those points, I think you will be able to find out more about it. In exam, we will be given the financial statements. For example, the balance sheet. We will have to calculate the ratios from the balance sheet. In this question as well, we are given a small balance sheet, which is assets and liabilities. So it is asking us the current ratio, a quick ratio, and cash ratio. As we know that the formula for current ratio is current assets divided by current liabilities, then we get the current ratios. In this example, the current assets are cash plus account receivable plus inventory, and the current liabilities is account payable plus accrued expenses. Yes, only these two. So we have the figure for cash is 20,000. Then account receivable is 40,000 plus the inventory is 40,000. Divide by account payable is 20,000 plus accrued expensive is 15,000. So the total current assets is 40 40 is 80 80 100,000 divide by 20 15 35. Uh, so if we calculate 100 divide by 35, we'll get the figure of 2.85 times of current ratio. Now let's calculate the quick ratio. As we know that quick ratio is current assets minus inventory divide by liabilities, current liabilities. So we know that the current assets is 100,000, inventory rupees is 40,000, and the current liabilities is 35,000. So we get 100 minus 40 60, 6,000 divided by 35. Then we get 60,000 divided by 35,000. We get 1.71 times as the quick ratio. Let's have a look in the cash ratio. So the cash ratio we can find out by dividing cash and bank amount divided by current liabilities. The cash in bank is we are given the 20,000. Then current liability is 35,000. 20 divided by 35 of 0.57 times. Let's have a look in another example. In this example, it is saying the following information were extracted from the financial statements year 2019. Sales 110, sales 10 lakh, which is 20% of cash. Cost of goods sold is 80% of sales, and inventory is given in 2 years, January 2019 and December 2019. And the firm has 380 net fixed assets and 8 lakh in total assets as December 2019. So it is asking us the inventory turnover ratio. Let's have a look. As we know that the formula for inventory turnover ratio is cost of goods sold divided by average inventory, where cost of goods sold we can find out. It says the cost of goods sold is 80% of sale. 80% of sales. What is the sales amount? Sales amount is 10 lakh. So 80% of sale is cost of goods sold. That means we get 8 lakhs. Cost of goods sold is 8 lakh. 1, 2, 3, 4, 5. Average inventory. We can found opening inventory plus closing inventory divided by 2. So opening inventory is given in 2019 January is opening inventory, which is 180 lakh, plus closing inventory is 220 lakh divided by 2. So let's get the figure. Figure we get is 180 plus 220 divided by 2. So we get here 200,000. So we divide 800,000 divided by, so 4 4 4 times. So the formula for receivable turnover ratio is credit sales divided by receivables. It's given here the credit sales is 20% is cash, so that means 80% is credit. 80% of 10 lakhs is 8 lakh. 1 2 1 3 4 5. So divide by receivables, the average receivable. Now we know that in the question it is given that the 20% of is in cash, so that means 80% is credit. So 80% of 10 lakh is 8 lakh. 8, 8 lakh is credit sales, and average receivable same like the average stock we calculated earlier. So to calculate the average receivable, we need to calculate the opening receivables plus closing receivables divide by 2. So we know that in the 100,000, then closing is given 3 lakhs 80,000 divide by 2. So altogether 4 lakh 80,000 divide by 2 is 24, 2 lakh 40,000. So 2 lakh 40,000 is average receivables. So let's calculate 8 lakh divide by 2 lakh 40,000, then 3.33 times of receivable turnover ratio. Formula for this is sales divided by fixed assets. Sales is total sales, which is 10 lakh. 10 lakh, then divide by fixed assets. Fixed assets is given here. The firm has 3 lakh 80,000 net fixed assets. So that means 3 lakh 80,000 is net assets. So let's divide 10 lakh divided by 3 lakh 80,000, 2.63 times of fixed assets turnover ratio. The formula for this total assets turnover ratio is total sales divided by total assets. The total sales is, as we know, again 10 lakh assets. So 8 lakhs is total assets. So let's divide 10 lakh divided by 8 lakhs. 10 lakh divided by 8 lakh. 1.25 times. Students, let's go to the next questions. In these questions, we are asked to calculate the total liabilities to assets ratio debt to equity ratio and equity multiplier. And we are again given the extract of balance sheet, um, which you can see the assets and liability side. Let's have a look one by one. Total liabilities to assets ratio. The form the formula is total liabilities divided by total assets. Most of the time the students get confused that the total of these liabilities and equities is the total liabilities, but it is not, because this is the, the right hand side of the balance sheet is uh, total liabilities and equities, so we have to deduct the equities from the total liabilities. So in this example, the common stock and return earning, these 2 points are not total liabilities, these are the equities. So only so from 17 lakh, let's deduct these 2 points. A common stock is 10 lakh, then the return earning is 120 lakh. So altogether it is 11 lakh 20,000. So from 17 lakh, let's minus 11,000, 11 lakh 20,000. So we get 5 lakh 80,000 total liabilities. 5 lakh 80,000 total liabilities. So let's divide 5 lakh 80,000 divided by 17 lakh. So we get the figure 0.35 is total liabilities to assets ratio. So second figure, we are asked to given debt to equity ratio. Debt to equity ratio formula is total debt divided by total equity. So in this point, the total debt is the total long-term debt, which is a long-term debt is again itself is 1 lakh, and a bond is 2 lakhs. So 3 lakhs is a total debt, divide by total equity. Total equity is common stock plus retained earnings total equity. So again 11,000 11 lakh 20,000 is total equity. 3 lakh divided by 11 lakh 20,000, then we get 0.68 times of debt to equity ratio. In C, we are asked to calculate the equity multiplier. Equity multiplier, total assets divided total equity. The total assets is, we know that again 17 lakh is total assets, 17 lakh. Total equity is 11 lakh 20,000, 1.51 times. Now let's have a look at another questions. In this example, we are given the income statement. Sometimes we are given the income statements and we will be asked to calculate the different ratios. So income statements, and it's asking to calculate the different ratio like gross profit, net profit, and as follows. First is GP margin. The formula is gross profit divided by sales multiplied by 100. We know that gross profit is 5 lakhs. Then The total sales is 20 lakh. Then we get figure 5 lakh divided by 20 lakh, which is, so we get 0.25 multiply 100 is 25% HGP. Let's calculate the net profit margin. For this, the formula is net profit divided by sales multiplied by 100. We know that net profit uh, is that the net income is net profit, which is 1,20,000 divided by, again, sales is 20 lakh multiplied by 100%. So we get 1,20,000 divided by 20 lakh. We get 0.06 multiplied by 100, which is 6% net profit. The third requirement is operating margin. The formula is earning before interest and tax divided by sales. We know that EBIT is 3 lakh, then sales is again 20 lakh multiplied by 100. Then we get 3 lakh divided by 0.15 is called 15%. 15% is operating margin. Let's go the next margin, which is return on assets. Return on assets, net income divided by total assets. So 120 divided by 8 lakh, which is 0.015 multiplied by 100% is called 15%. ROA is 15%. Now let's go another, which is return on equity, ROE. Formula is net income divided by total equity. Net income is 1,20,000 and total equity we are given here in information is 6 lakh. So 6 lakhs, let's divide 1,20,000 divided by 6 lakh. We get 0.02, again multiply by 100, we get 2%. In F, we are asked to calculate basic earning power. Basic earning power, BEP, is calculated by earning before interest and tax divided by total assets. So EBIT is, we know that 3 lakh. 1, 2, 3, 4. And total assets is, we know that 8 lakhs. 1, 2, 3, 4, 5 multiplied by 100. We get, let's divide 3 lakh divided by 8 lakh. We get 0.375 multiplied by 100, which is 37.5%. The final calculation is TIE ratio, which is, it is also known as interest coverage ratio, which is calculated earning before interest and tax, interest expenses. We know that EBIT is 3 lakh, then interest expenses is, we are given here, is 1 lakh. So in this way we get 3% is EBIT. Hello students, welcome to again. Hello students, hello students, hello students, welcome again. Now I'm here with a different type of questions. Hello students, welcome to my channel. Uh, Today I have a different patterns of questions. In examinations, you will be given this type of question as well, where you need to prepare the balance sheet on the basis of information you are given. You can see here the balance sheet. It asking is account receivable is question and inventory and net fixed assets, and in the liability side, it's asking notes payable and long-term debt. Then we are given the sales revenue, the GB margin. So all of the information on the basis of this piece of information, we'll be finding out the individual. Uh, so first of all, let's calculate the gross profit ratio. Let's start from gross profit ratio. Gross profit margin. GP margin is equal to gross profit divided by sales multiplied by 100. And in the informations we are given, the GP margin is 25%. So 25% GP margin, we don't know gross profit. And sales we are given the 18 lakh. 18 lakh is sales revenue. So GP is equal to, if we multiply 25, how much we get? 25 divided by 100 multiply by 18 lakh. We get the figure of 4 lakh 50,000 of gross profit. Let's calculate cost of goods sold. What's the formula for this? COGS is equal to sales sales minus gross profit. Then we get COGS. Sales is 18 lakh. Then gross profit is 4 lakh 50,000. Then we get 18 lakh minus 4 lakh 50. We get 13 lakh 50,000 as a cost of goods sold. Now we know the formula that inventory turnover ratio is equal to COGS divided by inventories. Now in the informations we are given that inventory turnover ratio is 6 times. So inventory turnover ratio is 6 times is equal to COGS. We are given 13 lakh 50,000, and inventory we don't know. Inventory. So we can find out inventory dividing 6. 13 lakh 50,000 divided by 6 is 2 lakh 25,000. So we got the inventory figure, which is 2 lakh 25,000. So let's put this amount here, 2 lakh 25,000. The average collection period, the average collection period is equal to uh, account receivable multiplied by 360, because we are given there are 360 days in a year, divide by sales. So let's put all the informations. Average collection period is 40 days. In the informations it is given 40 days. Average receivable 360. Sales is we are given again 18 lakh. So in this way we can find out account receivable days is 14 lakh multiplied by 40 divided by 360 days. Let's calculate 18 lakh multiply by 40 and divide by 360. We get exact figure of 2 lakh. So account receivable in the balance sheet we find out 2 lakhs. Now let's go to the next section. We need to find out the notes payable. We are given informations as a current ratio. Current ratio. What is the formula for this? Current ratio is current assets divided by current liabilities. So current ratio we are given as just 1.6 time 1.6. So current ratio, how do you find out? If you look in the informations in the balance sheet, current ratio is cash plus marketable securities, marketable securities plus account receivable we just calculated just now, plus inventory, divide by current liabilities. Current liabilities we are here is account payables, accounts payables plus notes payable plus accruals. So let's put all the figure over here. We know the cash is 32,720 plus marketable securities is 25,000. Account receivable which is calculated 2 lakhs plus inventory is 2 lakh 25,000. Account payable we know 1 lakh 20,000. Notes payable we don't know, that's we need to find out, plus accrual is 20,000. Let's do some calculations here. 32 720 plus 25,000 plus 2 lakhs plus 2 lakh 25,000. We get total current assets as a 4 lakh 82,720. Then we get 120 plus 20,000 is known as 140,000 plus notes payable 1.6. So we calculate here uh, notes payable plus 140,000 is equal to 4 lakh 82,720 multiplied by 1.6. uh, notes payable plus 140, 4,82,720 divided by 1.6. What do we get? 482,720 divided by 1.6. We get figure 301,700. Notes payable plus 140,000. So in this way, notes payable is 301,700 minus 1,40,000. 1,40,000. So we get 1,67,700 as a notes payable. So notes payable is 1,61,700. Now let's go to next section. Total assets turnover ratio. What's the formula for this? Sales divided by total assets. We are given the total assets turnover ratio is 1.2 and sales we know 18 lakh. Total assets in this way we get total assets is equal to 1 lakh 18 lakh divided by 1.2. 18 lakh we get 15 lakh as a total assets. Total assets is we find out here is a 15 lakh. Now let's calculate another figure F. Total liabilities to assets ratio. As we know that total liabilities divided by total assets. So total assets to liabilities, total liabilities to assets is 60% is equal to total liabilities. We don't know total assets. We know 15 lakh. We just calculated. So total liabilities here is 60% multiplied by 15 lakh. We get how much we get 60,000. Um, uh, 15 lakh. We get 9 lakh. Let's calculate long term debt, which is this figure. Total liabilities minus current liabilities. So current liabilities here, uh, it's account payable 120, 1,20,000 plus notes payable 161,700 plus accruals 20,000. So total liabilities we just calculated is 9 lakh. Let's let's add up all of those current assets figure, current liabilities figures, which is 120 plus 161.7 plus 20,000. We get 3 lakh 1,700. Just minus from 9 lakh. We get 5 lakh 98,300 as a long term debt. So we can put this figure over here in the liability side, which is 5 lakh 98,300. Let's add up all of this figure that we need to find out the 15 lakh. Otherwise, our calculation is wrong. So 1,20,000 plus 161.7 plus 20,000 plus 5,98,300 plus stockholders equity is 6 lakh, which is exactly 15 lakh.